You think a coin goes up because the project is strong and goes down because the market turned bearish? Sometimes, yes, but very often, between you and the price, there are market makers. They provide liquidity and keep markets running smoothly, and in a lightly regulated crypto market, they often have far more freedom than most traders realize. In this video, we'll break down who market makers really are, how they make money, why crypto gives them more power than traditional markets, and most importantly, how not to become their liquidity. A market maker is not someone predicting price direction. A market maker is a professional participant who continuously places both buy and sell orders for an asset. When you press buy or sell, the counterparty is often not another retail trader. It's a market maker stepping in so the trade executes instantly. Without them, markets would look very different. Thin order books, huge spreads, and prices jumping wildly from small trades. Market makers turn chaos into structure. They make trading fast, liquid, and predictable. Imagine a newly listed token. The order book is almost empty. A few buyers here, a few sellers there, big gaps in between. Any market order sends the price flying. Confidence disappears instantly. Market makers step in and populate the order book, narrow the spread, and absorb buy or sell pressure. This is why exchanges rely on them. Liquidity creates trust. Trust brings volume. But whoever controls liquidity also influences behavior. Market makers don't need to guess where price is going. Their income comes from three main sources. First, spread capture. They buy slightly cheaper and sell slightly higher, thousands of times per day. Second, arbitrage. If prices differ across exchanges, they buy on one and sell on another, keeping the market aligned. Third, exchange incentives. Lower fees, rebates, and preferential infrastructure access turn liquidity itself into a business. Their goal isn't direction, it's flow. Market makers are powerful, but not invincible. Their biggest risk is inventory risk. If price moves too fast, their systems may fail to rebalance in time, leaving them stuck with unwanted positions. This is why during panic events you see wider spreads, vanishing order books, and sudden drops in liquidity. Often this isn't manipulation, it's self-protection. Important disclaimer. Not every strange price wick is a conspiracy. Sometimes the market really is just messy. But believing everything is random is just as naive. You don't need a tinfoil hat, but you should probably take off the rose-colored glasses. Here's the core issue. Crypto markets are far less regulated than traditional finance. Practices that would be illegal on stock exchanges often exist in gray areas or aren't enforced at all in crypto. Market makers have more freedom, less disclosure, and fewer consequences. That doesn't mean all of them act unfairly, but it does mean the risks for retail traders are higher. One risk is fake liquidity, often called spoofing. Large buy or sell orders appear in the order book with no intention of being filled. They influence trader psychology, then disappear the moment price approaches. If you see massive walls at obvious levels that vanish instantly, be careful. Don't trade based only on what the order book shows. Watch how price actually reacts. Another risk is artificial volume, known as wash trading. Trades between related accounts inflate volume without real demand. A token looks active, but interest exists only on paper. If volume is high on one exchange and low everywhere else, that's a red flag. Healthy demand shows up across the market. Stop-loss hunting is another common tactic. Retail traders place stops at obvious levels, round numbers, and clear support zones. Price briefly moves there, liquidates positions, then quickly returns. If you see long wicks through key levels followed by fast recovery, that's often liquidity extraction. Avoid placing stops at predictable prices. Use zones, not exact numbers. On decentralized exchanges, front-running and MEV are real risks. Your transaction is visible before execution. Bots can jump ahead, pushing price against you. If you consistently get worse execution than expected or slippage triggers unexpectedly, this may be happening. Lower slippage tolerance, split large trades, and avoid thin liquidity pools. Low liquidity tokens are the easiest to manipulate. Small amounts of capital can move price dramatically. Rapid vertical moves without fundamentals, wide spreads, and shallow order books are warning signs. If price can be moved cheaply, it can be abused. Market makers are neither heroes nor villains. Without them, crypto markets wouldn't function. With them, the game becomes more sophisticated. Your edge isn't speed, it isn't insider information. Your edge is understanding how liquidity works and choosing markets where manipulation is harder. Trade where professionals have less room to play games, and you'll stop being their exit liquidity.